Hi, my name is Jim and I was retired. Here's another short video this week on inflation. After some surprising numbers on the CPI for October, which came in at 7.7% year over year and 6.3 on a core CPI, the stock market went crazy. A lot of people think this is definite that inflation has peaked, and that'll mean the Fed will slow down rate increases, right? Well, not so fast. In fact, I think we're still left with three important questions. The questions that we had after the last FOMC meeting. How fast, how high, and how long will rates have to go up to really contain inflation? Stay tuned. I put out some of these charts on my Twitter feed, and if you haven't signed up for Twitter, use the link below to sign up for my Twitter feed. CPIU, Consumer Price Index for Urban Workers, came out for the month of October, 7.7 year over year, a substantial decline. 7.7 is the headline number, but we also track the core CPI without food and gas, mainly because that is a precursor to what the personal consumption expenditures inflation reading that the Fed really uses will likely be in a few weeks. So if core CPI is 6.3% in October, then this 6.2 from September is likely to go down again too. We don't know for sure. It has deviated in the past as well, but it's a hopeful sign that we are beyond inflation. A lot of people were excited about this news. However, as I've pointed out on my Twitter feed, the Fed funds rate is still about 225 basis points too low to really catch up with inflation. We have a way to go before we are on top of the inflation rate and can really start pushing it down. Now, another way to look at this is a lot of people are expecting now a 50 basis point hike in December and maybe continue that pace or slow down further to 25 basis points. I would still prefer we continue with 75 basis points until we are well above the inflation rate and then slow down. But I'm not going to win on this one. Here are the numbers again. This is the CPI 7.7. The PCE in September was 6.2. And if you use the nowcasts from Cleveland Fed, it's going to go down a little bit further. Now, on the core CPI, if it were to continue its declines, and it declined 0.3 in the last month, if it stayed on that pace, then it might reach about 4.9 by next March. And if you had 50 basis point increases through March, you're going to end up with a 5.5 on the federal funds rate, which will be about a half a point above the inflation rate, which is the ideal way it should help contain inflation. If you did a quarter point hikes, though, you're likely to come up short. A quarter point would only hit 4.75 by next March, and that is short of inflation, and it's not going to contain the inflation. And just this morning, the Michigan inflation expectation number came out, and it went up from 5 to 5.1%. Now, that's the expectation of consumers for what do you think inflation will be 12 months from now. You'd like to see that lower, not higher than the previous month. So I'm not sure we're there yet at containing inflation expectations or inflation. So that leads me to believe we should stay with 75 basis points until we can affect that inflation expectations and bring it back down to its longer run range. Now, I'm not an economist and I'm not a financial planner, so just take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.